Advanced Financial Modeling, Topic 18, Forecasting Financial Statements. Topic 2, we're going to evaluate external funds needed and capital structure decisions, in other words, financing decisions. So in the last topic, we did a first pass of our financial statements. And what we did is we assumed sales growth were 20%. I'm going to switch over to the spreadsheet. And I assumed that my short-term assets also grew at 20%, kept dividend payout the same, made a few other assumptions. And what we determined is to get that 20% sales growth, I'm going to need a 20% increase in assets. In other words, and in the end, I'm going to need to finance an extra $153 of asset growth. So let's talk about different ways in which we could look at this growth or finance this growth. We're going to look at 4 different plans. One is, what if we finance this EFN, this external funds needed, 100% with issuing new stock? Then we'll look at eliminating the dividend and 100% stock. Number 3, we'll look at 100% debt financing, and then we'll do some kind of mixed plan between debt and equity. So let's go ahead and do a total financing using the first plan of using stock. So I'm going to go back to the spreadsheet. Remember that when I put in bank loans, long-term debt, and common stock, I just said it's the prior year's balance plus the changes that I'm specifying in E16, 17, 18. So a simple way to close this gap between assets and liabilities and equity, in other words, this unbalanced balance sheet, is to just put in that balance, 153.36. That's going to increase my common stock by 153, and it's going to close my balance. I've balanced my balance sheet. So I've actually done my second pass. And then what you can do is you can evaluate the impact of that decision. What you can see is if I had 100 shares outstanding in the prior year and the stock price was trading at $15 a share, by issuing $153 of stock, if I take 153 divided by $15 a share, that must have been the number of shares I've issued. So it looks like I had to issue 10.22 shares of stock to issue $153 in stock at a stock price of 15, which will give me a new EPS because I have more shares and I have a higher net income. So it looks like this assumption is going to have our net income going up by about 15%, going from about 102 to 117. And I can look at it using the DuPont formula. I can look at how it affects my asset turnover, equity multiplier, profit margin. And you can see my total ROE goes from 1365 to 1289. So this is an easy way to close your gap if you want to use common stock to finance that difference. The second thing we'll look at is, well, maybe before we issue common stock, let's see if we can just eliminate the dividend first. So what we could do is, I'm going to put this back to 0. And the question is, like, why pay a dividend if I'm raising stock? So one answer could be, I'm going to take the payout ratio to 0 first. Notice my EFN goes to 121, and then I could just finance the 121.15. But sometimes investors get nervous when we cancel dividends, so let's just leave that at 25%. A third way we can do it is use debt financing. So let's just not play around with the bank loans. Let's just play around with long-term debt. So let's go back to my spreadsheet. What if I want to balance my balance sheet, take that $153.36 of external funds needed and put it in debt, 153.36. Now watch what happens to EFN right here when I hit enter. It didn't close the gap, and here's why. When I put an extra 153 in debt, right, and this number increased, the interest expense up here increased by 8% of that 153. And that difference, that 8% of 153, I think is the 690 after tax. So what happens is by creating more debt, I'm creating more interest expense, which then is lowering my net income, which is then lowering my retained earnings, so I don't close the gap. So now we have to do a third pass. Whenever you use debt or change cash balances which affect interest expense, the second pass which balances our balance sheet if we use equity, doesn't work. So what we need to do is we need to finance that extra interest expense of $690. So what I can do is I'll finance that $153, but I'm going to add another $690. And notice it doesn't balance it again, because what's happening is that extra $690 of debt is generating another 8% of interest on that debt, which is then lowering my retained earnings again. So I'm going to try to finance that 31 cents. And I'm almost there. Now I have 2-cent gap, and I can finance that 2-cent gap. And now I've balanced my balance sheet, having to use the third pass because I changed debt or cash balances, and this will be a way to to close that gap between assets and liabilities and equity and get my balance sheet to balance. The fourth one is maybe we'll use a mix of debt and equity. Say we use half debt and half equity. So what we'll do, we'll go back here, we'll take this out, and it says it's 153.36. So what I'll do is I'll take 153.36 and multiply times 1/2. So I want to finance half of it with debt and I'll just copy that formula and half with equity. And notice that again I'm not balanced because I used some debt, so I had to finance that 345. So what I could do is I can add that 345 and finance it half with debt times 0.5. Whoops, let me change that back. I'm going to take that number and add my 3.45 times 0.5, half of it being financed with debt. Copy that there, and I'm 8 cents off, so I can add that 8 cents times 0.5. Copy that, and looks like I'm balanced. So one way to balance my balance sheet using a mix of debt and equity is to keep going back on that third pass until the balance sheet is balanced by keep adding that incremental interest expense. So that's how we balance the balance sheet and try to determine how we're going to finance the level of assets we need to get to our sales target. Let's talk a little bit about EFN, that external funds needed, that difference between assets and liabilities and equity. So in the example we just did, the company, to finance that EFN, could pay a smaller dividend, which increases the L&E. It could issue new stock. It could issue debt or bank loans. What we didn't do is decrease cash balances. Maybe the company doesn't need all that cash to run the business. And if it's getting a relatively low interest on cash, it could just reduce the cash balances, in other words, reduce the assets. Or maybe we'd have to buy less fixed assets, but that's probably going to have a feedback effect. If I reduce my CapEx, I should probably reduce my sales because I'm not going to have the production capability. Now, if the EFN is negative, what that actually is telling you is you have extra money to invest. Your assets are less than liabilities and equity. You have too much financing. So what you could do is you actually can pay a larger dividend. You could repurchase stock, put a negative number in there. You could pay down debt. You can increase your cash balance, or you can buy more fixed assets, which probably has an increase in sales. So let's take look at an example in which we might have negative EFN. So in that example is going to be negative sales growth, which I'll also assume is going to be a negative short-term assets and liability growth. So back to my spreadsheet. So all I want to do is I want to zero out my changes in capital structure. I'm going to put in a 0 sales growth, 0 short-term assets. And what you see is my EFN, my external funds needed, is negative 76. Let's think about what that means. Based on this forecast, I need 1350 of assets, but I'm forecasting I have 1427 of financing, liabilities, and equity. Well, how can I close that gap? Well, I can look at maybe paying a bigger dividend, maybe change that to 50. That helps out a little bit, but I'll just leave that to where it was. I could pay down some or buy back some common stock. So I could go ahead and put in there minus 76.78 of common stock. That closes the gap. Now notice the effect here. If you want to buy back $76 of stock at $15 a share, you're going to reduce shares by about 5.2 shares. And so my shares outstanding is going to fall. And here's my effect on EPS. Or I could do a mixed strategy again. Another strategy, I hate to do this with a spreadsheet, but you could just hold it as cash, that extra money as cash. So I could just hold that extra 76.78 as cash. Notice it doesn't balance it because what happened is I generated some extra interest income. So I need to add another 87 cents, and there I go. All right, that's a little dangerous. I hate putting in numbers in with formulas, but that's a way of holding on to the cash. Maybe you'll need it next year. So this is how you could finance negative EFN, which is generally a good situation. So in this topic, we forecasted external funds needed and did our second and third passes of our pro forma or forecasted financial statements.